Welcome back to Coinblah. Right now, we are standing at a massive inflection point, watching a new page of financial history turn right before our eyes. We need to talk about the decision made back on November 18, 2025, when the Office of the Comptroller of the Currency, the OCC, essentially gave the green light for banks to enter the crypto market. That single decision is causing a butterfly effect that we are just starting to see play out. In today's episode, we aren't doing the usual Bitcoin is going to the moon price predictions. Instead, we're looking at where the highway for massive institutional capital is actually being paved. We're going to focus on the only blockchain projects that are truly qualified to drive on this road, specifically XDC and Algorand. Let's look at the facts and the outlook. Let's rewind the clock a bit to the period between 2022 and 2024. Back then, Wall Street banks were stuck in a huge dilemma. Their clients were screaming for crypto, but the banks' hands were tied. Think of it like buying a high-performance Ferrari, but finding out the garage door has been welded shut. That welded door was a specific accounting rule from the SEC known as SAB 121. Simply put, this rule demanded that if a bank wanted to hold a customer's crypto, they had to hold an equivalent amount of cash as a liability. For a bank, that math just didn't work. It was a non-starter. However, fast forward to the first half of 2025. Thanks to relentless pressure from Congress and a shifting political landscape, that regulation lost its teeth. Then came November, when the OCC finally sent the signal everyone was waiting for. It is now okay to handle real-world assets and stablecoins. Just like that, the welded garage door flew open. But here is the million-dollar question. Once that door opened, did banks just run out and grab every random coin they could find? Absolutely not. We have to understand the DNA of a bank. What keeps a banker up at night isn't necessarily hacking, it's something scarier to them: opaqueness. In the traditional blockchain world, anonymity was the virtue. It was like a masquerade ball, where the benefit was trading without revealing your identity. But in institutional finance, that mask looks a lot like potential criminal activity. If you were a bank CEO, would you authorize a $100 million bond trade with a guy in a black ski mask? Of course not. Under anti-money laundering laws and KYC regulations, dealing with an unidentified entity isn't just risky, it's a one-way ticket to getting your bank shut down. So, here in 2026, the projects that banks are actually looking at are very specific. They want blockchains that have taken off the mask. And right at the center of this movement is the XDC Network. A lot of people just think of XDC as a payment coin, but the real game changer is its integration with GLEIF. GLEIF is a G20-approved international organization that issues LEI codes. Think of them as social security numbers for corporations globally. XDC is the world's first case where these LEI codes are embedded right into the validator nodes, the very heart of the system. Let me give you an analogy to explain why this is huge. Traditional crypto transfers are like getting a phone call from a restricted number. You don't know who it is. But a transaction on the XDC network, that's like a high-definition video call where the caller's face, company name, and job title pop up on the screen. When a trade happens on XDC, the system automatically validates it. This transaction is from the verified Samsung Electronics, or these funds belong to the verified Deutsche Bank. Bank employees don't have to manually review piles of paperwork. The blockchain acts as the guarantor of identity. It's basically a cheat code that drastically slashes compliance costs. Alongside XDC, there is another project we absolutely must focus on: Algorand. In financial transactions, there is one thing just as important as identity, and that's finality. Imagine you swipe your card at a grocery store, and an hour later you get a text saying your payment might be canceled, or maybe not. That's a nightmare. With legacy chains like Bitcoin or Ethereum, there's a theoretical chance of a fork where the ledger splits in two. Banks cannot tolerate that uncertainty. Algorand, however, is architected so that this split simply cannot happen. The moment you hit the transaction button, it is final. This is called immediate finality. This isn't just theory. Italy's Banking and Insurance Association has already adopted Algorand technology for their digital guarantee platform specifically because of this stability. They needed a system that was flawless and instant to replace their old networks, and Algorand was the one that met that standard. Now, let's widen our lens to the future beyond 2026. We are standing in front of the massive wave of asset tokenization, or RWA. Real estate, government bonds, fine art, all these physical assets are putting on digital clothes and moving onto the blockchain. Now, skeptics might ask, won't giants like JP Morgan just use their own private blockchains? Sure, in the beginning they might, just like companies in the 1990s insisted on using closed intranets. But eventually, the world has to connect. If you want to send a token issued by JP Morgan to Shinhan Bank and then move it to a European insurance firm, you need a public blockchain, a common highway that connects these different systems. The requirements to be that highway are simple but strict. First, the driver's identity must be verified. That's XDC. Second, the road must never crack or split. That's Algorand. 2026 is the year these projects move past the proof of concept phase and become the actual arteries of the financial system. In conclusion, the OCC's deregulation wasn't just unlocking a door, it was destroying the dam that separated the legacy financial system from the blockchain world. The water is going to flow, and it will naturally flow towards the safest, most transparent channels. Rather than getting emotional over short-term price volatility, now is the time to coldly assess who has the functional readiness to satisfy the bank's picky standards. The projects wearing masks will be left behind. The ones wearing ID badges will survive. That's the fact check and analysis from Coinblah today. Keep watching as we track the flow of this changing monetary system. Thanks for tuning in.